And joining us now to share his commentary on the day's market performance is Roy Mutooni from Sanlam Investments. Roy, thanks so much for your time this afternoon. So geopolitics still in focus, still under the spotlight. And this after Trump's surprise move. We went from a 2-week delay to markets or two hits in Iran over the weekend. Markets' response has been quite interesting, though. The impact seems to be limited. Gains in oil aren't holding. You'd expect to see a bloodbath in markets. What's happening?
Well, the thing is, so it's like you say, he had promised in 2 weeks, and I think the market had become very sanguine with all of these Trump deadlines. And then he went ahead over the weekend. So that vanquished two things. First of all, the whole Trump always chickens out. Clearly he didn't, and he did the attack. It came in well in advance of what would happen with the futures markets coming in. So even over the weekend, the market could recalibrate itself and think. And he's made it clear that it's a once-off, and in his mind, they've obliterated, in his words, the Iranian nuclear capability. So I think from a market perspective, what we're waiting for is the other shoe to drop. What will Iran do? What's their retaliation? It's quite clear that the U.S. is is not going to pursue regime change at this point in time, which would extend everything and increase volatility, and that would impact the price of oil quite significantly. And in their minds, this is over. It's time to talk. It's time for peace. So I think that's what the market is grappling to price. On the surface, it was a once-off hit, and we will move on, and that's why the oil price hasn't moved. But the undertone is, what will Iran do? If the scale of Iran's response is military, it's belligerent, it's against the U.S. directly, then expect a completely different set of circumstances for both the oil price and for risk assets, specifically equity markets. So I think it's wait and see, very tense, very volatile at this point in time. Don't trust the movements as they stand right now.
Okay, so you wouldn't say that markets are underestimating what's taking place at the moment. I was also looking at the VIX, also not much movement on that front.
No, I mean, even if you look at, like we've learned from the election that even the betting markets are quite important here. So the betting markets seem to show that there's a high probability of retaliation. There's a high probability of the Straits of Hormuz, which is where I think 20 to 22% of global oil passes through, may be blockaded, but it's not 100% certainty. So it's clear that bad things may happen. It's not clear to what extent, and it's not clear for how long. But there's a clear feel that I think all of the players in this particular unfortunate incident are looking for some form of off-ramp that de-escalates. It's not clear what that off-ramp will be.
Yeah. All right, let's move over to some company news. Double-digit earnings growth from both Naspers and Prosus, boosted, of course, by the e-commerce division and proceeds from Tencent. Just your analysis on those numbers. The last time I checked, both counters were up 2%.
No, absolutely. I think they're very good results. I think well in line with guidance, so not much of a surprise there. Remember, with Naspers and Prosus, if you like the Tencent result, then you generally will like the two. But on top of that, on the Prosus side, this was the first time they generated free cash flow ex-Tencent. So they're actually sustainable on their own, and the investment profile is making sense. There's a big increase of the dividend there, and it looks like the outlook is improving over time. So you have an underpin in that the ex-Naspers, the ex-Tencent assets seem to now be working as operations and generating free cash flow, which reduces the whole criticism that everyone has always had, that this is just Naspers, that Naspers and Prosus are just simply Tencent with a whole bunch of other assets. So I think quite a solid result. The market likes it, and it bodes well for the future for those stocks. But remember, the underpin of all of this is when Tencent does well, then these two should do well. And all you're looking at is the discounts between the relative between the relative assets.
And what have you been making of Processes shopping spree? We've seen them really go into the European market, with some even saying that they want to actually show that there is value outside of the Chinese market.
Well, the thing is, that's definitely the incentive that current management have been given to try and create a business that replicates what Tencent did previously.
Yeah.
They're betting big on delivery, all of these food delivery businesses. That's a business model that hasn't been proven on a global basis. But the new CEO seems to have had pretty good experience and turned around a business in under his previous hat. So that seems to be what they're trying to follow. Use a previously proven formula and try and replicate that so that you can create value for shareholders. It will be interesting to see what happens, but the short term just seems quite promising. They're still generating good cash. As they invest the money, these operations seems to be integrating and scaling up relatively well. They're currently actually doing a capital markets day in Europe. So we're going to hear a lot more detail over the next few days about what these ex-Chinese assets are doing. And I think the market is looking very closely for any hints of progress from where we were previously.
All right, let's hit pause on the conversation. Let's take a moment now and touch on what your industry peers find interesting.
In Hong Kong, Anta Sports, and this is the leading sportswear retailer in China. Not as well known in the developed world, but it's the third largest sports manufacturer in the world, behind Nike and Adidas. Got some great brands behind it. I think what we like is that there's a really long growth runway for the stock. Per capita sports consumption is rising around the world, but particularly in China, and that's in a really still quite a depressed consumer environment. I think they have turned the corner there, but they're still a long way from kind of the heady days before the property sector put a dampener on that. So yeah, we're expecting consumer sentiment to improve and Anta to be a direct beneficiary of that. Got a great e-commerce platform as well as brick and mortar stores, strong balance sheet, and yeah, we think it's a great way to get exposure to the Chinese consumer.
Yeah, I actually had two stocks that I was debating here at home. The one being Super Group. They paid that special dividend in the week and the share price was down by 50%, suggesting a slight re-rating in the rump that was trading at like a 2 times PE. It's probably trading at a 3 times PE now. Their management team has been buying into the stock now aggressively as well, and that's always a good indication in terms of what the management team is thinking from a valuation perspective. So that was one. And then the other one that I actually ended up settling on, we've already covered. It's Libstar. So I think it's an opportunity. It's early for them in terms of their turnaround story, their portfolio cleanup, as well as their focus on some of the core businesses in Libstar. But the update that we got, even though not fully comparable, the fact that we are seeing decent volume gain and the ability of them to push through decent price increases as well, I think is a good leading indicator of what's to come.
So Chantal, going with local stocks, Libstar and Super Group. Devin, picking an international stock, Anta Sports. Just your analysis on those counters. Are these stocks you're looking at, liking?
So Super Group is a stock that I'm quite familiar with, and I liked the business that they got rid of, but I understood why. I don't think it was reflecting much in terms of value. It wasn't reflecting in the share price here. Both of them were small caps in their respective markets, so they were not getting the recognition required, and they got a really good price for it. So now this becomes a more concentrated business, particularly when you count the European assets that they will get rid of because they're underperforming, and they just seem to be ex-growth. But when you look at the SA assets, they're definitely worth more than a 3 PE, for sure. These guys are in logistics, they're in consumer logistics, they've got a fleet business that consistently grows and consistently adds value. So I think over time, as the market gets used to them, and used to them in their current format, what would happen is maybe management bulks up the business a little bit, or this renewed focus allows them to start growing earnings again. I think at this point in time, they're probably at the bottom of their earnings cycle and are looking to start picking up, particularly in the ex-SA businesses, the businesses that transport commodities out of Africa through SA into the rest of the world. So no, I think a solid management team. They've got it's going to be a long slog to reconstruct this business to be a sizable one. But I think they've done it before. They can do it again.
All right, let's leave it there for now. We'll catch up with you in the next 15 minutes or so. That was Roy Mutooni from Sanlam Investments.